Good day to all. My name is Chloe, a senior research analyst from iFAST. India stands out in the global market amidst a slowdown. The Sensex index is currently near its all-time high as Indian economy is defying odds and brushing off pressures from higher rates after the Reserve Bank of India opted to pause rate hikes. India benefits from many secular growth drivers. The most important of that is its demographics. This is where India has a distinct advantage over other Asian economies. In fact, India has overtaken China as the world's most populous country, according to UN population estimates, with the Indian market being characterized by a large and young population, with half of the population being under the age of 30. Moreover, India is coming into prominence, especially given its position as a robust alternative to China. India is in fact a key beneficiary of the relocation of supply chain away from China due to the ongoing US-China tensions. Take for instance, Apple wants India to account for up to 25% of its production, up from 5 to 7% respectively. More recently, Micron Technology announced that they will be investing up to $825 million in a new chip assembly and test facility in India. However, despite India's huge growth potential, there are some challenges which may impede its growth. Twin deficits in the form of fiscal and current account deficits could potentially threaten the stability of the country's currency, causing its currency to depreciate. Acknowledging and addressing these concerns is crucial for India to keep its financial footing firm. Education, the cornerstone of progress, is another area that demands attention. Low literacy rates hinders labour productivity, and it holds back the full potential of India's workforce. The nation must invest in empowering its people with knowledge and skills to ensure a future of prosperity for all. Moreover, the shadows of corporate governance and corruption issues, they loom, and this casts doubts on the journey ahead. To secure a bright future, India must promote transparency, integrity, and accountability in its corporate practices. While the outlook for India remains promising, it's essential to tread with caution. Valuations for Indian equities are high, possibly limiting further upside potential to 7% over the next 2 years, based on its historical fair P multiple of 19 times. Nevertheless, for those who are eager to dip their toes into Indian equities, a regular savings plan may be a prudent approach. Such a strategy allows investors to take measured steps and build a strong foundation for their financial goals. To get the full analysis, scan the QR code or click on the link in the description below. Next up, Cyrus will share more about 𝗠𝗆𝘆's bonds. Over to you, Cyrus.
Hi, I'm Cyrus, research analyst from the iFAST research team. Most of us will have heard of or even stayed in Shangri-La's many luxury hotels across APAC. Today, let's look at some bonds issued by Shangri-La Hotels and explain why we like Shangri-La's 2025 bonds. Shangri-La saw a broad-based recovery in revenues in its most recent FY22. Within the hotel segment, revenue per available room, or RevPAR, generally increased across most geographies. Even though China lagged behind because it only reopened late last year, management has already witnessed a surge in mainland China demand over the recent Chinese New Year period, and we may see positive benefits as early as this year. As for net income, Shangri-La saw its net losses narrow in FY22. However, we think that Shangri-La can build on this momentum in revenues and remains firmly on the path to profitability. Shangri-La's credit profile also remains stable. Some of its key liquidity ratios like current ratio, cash ratio, and operating cash flow ratio generally improved year on year as well. We also like that its debt maturity schedule remains manageable, with just 1/3 of debt due by 2024 and majority of FY23 refinancing already completed. As a whole, we think that the 2025 bond can benefit significantly from China's reopening, and provides a solid yield of 4.25% for much lower duration risk compared to its 2028 and 2030 bonds, helping it to stand out from its peers. This wraps up the sharing for this week. Catch us again next week for more investment ideas and updates.